The other aspect of competition is our interest rates compared with other countries because of persistent inflation and a brave effort to maintain as many jobs as possible while waiting for inflation to ease lower. Our rates now are higher than many other developed nations. One person with a unique view of Australia's interest rates is Lucy Ellis, the Chief Economist at Westpac and until around 18 months ago, the Assistant Governor of Economics at the Reserve Bank. And I caught up with her late this week.
Almost all of the employment growth that's happened over the last year and a half has been in what we call the non-market sector. It's in industries like health and social care, education and public admin and defence. And it happens that each job in those industries, each hour worked in those industries, produces less GDP on average than all of the jobs in the market sector. That's not saying they're worthless, it's just how things are priced, how GDP is measured. And if you think about some of those jobs, they're really important things like aged care workers, childcare workers. They're pretty low paid, they contribute less GDP per hour worked, but they're doing something very important. Because we've increased the share of employment in those industries, in those specific jobs that are care work, that are relatively lowly paid, we've managed to drag down the average GDP per hour worked, which is what all economists mean when they talk about productivity. And so we've produced a lot of jobs, but we don't have that much GDP to show for it.
Okay, but then it's argued that if productivity is low, that prevents the Reserve Bank from cutting interest rates. Why is that?
Well, the Reserve Bank is thinking about how demand and supply balance up. And because we've had such a strong jobs market, high inflation and yet weak GDP, they've come to the conclusion that the supply side of the economy is still quite low, and so demand is exceeding supply, and they infer that almost entirely from inflation numbers. Now, that's one way of looking at it. But the question is, what happens to supply from here? And one thing we do know is that productivity, that GDP per hour worked, is actually rising at a pretty decent clip outside that non-market sector. It's running at about 1-ish% per year, which is exactly what we were doing pre-pandemic, and it's perfectly fine if you're running wages growth with a 3 in front of the decimal place.
Okay, can I jump in there and ask, if all of these important services jobs are being created, many of them by state and federal governments, is that an efficient use of the taxpayers' money if it's not actually producing a positive productivity outcome?
Well, I think we need to look beyond just GDP. I think we need to understand that these are jobs that do, under current pricing, produce less GDP. Per hour worked, but that's always the case. There are some jobs, like in mining, where you have so much capital equipment to work with. The mining industry, GDP per hour worked, is 8 or 9 times what it is in the rest of the economy. One thing we do know is that a lot of this ramp up in jobs, it's not going to keep going forever at this pace. We've had this ramp up in the NDIS, we've had decisions about expanding aged care, childcare. Those things have really important spillover effects. I mean, anyone who's had to deal with an elderly parent, had to deal with a disabled child, having someone who can look after that person and who's had more practice at it because they're a professional at it, that's always going to be an outcome that then sort of frees up someone else to do something else. So there are really important social benefits to having a better quality care for our children, for our disabled, for our elderly, and potentially keep people at home who might otherwise have had to go into a nursing home, potentially free up someone else in the family who might otherwise be a full-time carer. So there are really important social things that GDP and productivity just don't capture, and I think we need to have an open conversation about that.
So can I take you to another aspect of employment because of this? And that is the so-called non-accelerating inflationary rate of unemployment. So for people who don't understand that, it's where is full employment?
Yes.
Now, Treasury says it thinks it's at 4.25%. The Reserve Bank in the past has given hints it thinks it's about 4.5%. The ACTU thinks it's probably somewhere around about 4 or less. it's hard to judge this because you can only judge it in hindsight, can't you?
Well, in fact, you can't measure it. I even gave a speech about this in my old job. And the reality is typically the way you would infer whether you were above or below this so-called NAIRU is wages growth accelerating, is wages growth picking up, or is wages growth falling? That's what it means by the non-accelerating inflation.
But at the moment, we have fairly full employment. Unemployment this week has come down to 3.9%.
Yeah.
You kind of expect, even when you're seeing some of the wage claims out there at the moment, the Woolworths case was a classic one a couple of weeks ago, there is pressure for wages to rise above inflation.
Couple of things going on. One is overall wages growth has slowed, and it's slowed more sharply than the RBA was forecasting. And that's one of the things that they've highlighted as one of the reasons for their recent change of heart and change of language.
Were you surprised by that, by the way?
I thought it was possible, but I thought they were going to dig their heels in about their analysis about the NAIRU.
Yes.
I thought they were going to be a bit more, oh no, we haven't seen this. I mean, as recently as the 28th of November, the governor gave a speech where it was all about the labour market being tighter than full employment, tighter than was consistent with inflation at target, and then not even 2 weeks later they changed their language. So what changed in the middle? Well, they obviously sort of had another think about the wages numbers that they'd already received. Wages growth didn't even appear in that speech. But also they got the national accounts, and I think the combination of the labour cost measures in the national accounts, the weakness in the national accounts, and then put that on top of the wages growth numbers, that sort of suggests to you that maybe things weren't as tight as they thought. Because again, their frame of reference is if inflation is above target, that's telling you demand's outstripping supply. Well, maybe you need to allow for the lags. Maybe you need to allow for the possibility that supply kind of improves more quickly than they're currently assuming. And I think some of these elements are shaping their change of heart.
Okay, so then we go out into 2025. The government clearly would have loved to have had a rate cut or two during the election campaign, ahead of the election campaign, to say, hey, our strategy is working. Do you get a sense that the economy is now starting to revert? I mean, it was always said to be a long, slow path for Australia, which took a different route to other parts of the world. Do you sense that that's now playing out?
Well, I think the strategy that the RBA set a couple of years ago is absolutely playing out as they would have hoped. The labour market has not seen a big weakening the way you have in, say, New Zealand. You haven't seen that sort of real hit to the system. So rather than going really hard the way Canada and New Zealand did, and then relying on having the willingness to pivot very quickly, maybe before you're really sure that inflation is on track, they've done things in such a way to avoid that risk of overshooting. But it still does require you to start cutting rates, and reducing the amount of restriction in your monetary policy stance ahead of actually hitting target, because monetary policy operates with a lag. And that's why their assessment of full employment is so important. And so one of the things we've been highlighting at Westpac Economics is, well, we've got all this growth in the care economy at the moment, but it is a ramp up. It's not a permanent state of affairs that the share of the economy that's care economy is just going to keep growing and growing and growing. It's going to ease off at some point.
Take me to your interest rate forecast as it sits right now, because where do you sense that might be, and has that really changed even during the course of this week?
Well, it has been a bit of a wild ride for market pricing, that's for sure. I think it's fair to say that the probability of an earlier rate cut than our base case of May has increased, at least a bit, but we said that when we changed our call to May. It was really about, previously our base case had been February, with a risk of sort of something later, and then the probabilities just sort of switched a little bit. They've come back a little bit the other way, but I really wouldn't want to make a, hand on the heart call about whether, February's on the table until I see that December quarter inflation number. If trimmed mean inflation comes in noticeably but below what we and the RBA are expecting, I think that might be a trigger for an earlier move, but we really need to see how things play out from here.
Lucy Ellis, always great to chat to you. Many thanks for your time.
You're very welcome, Ross. Thanks.